Well, let's start with 3i then in that case, because the thing is down 17.5% today, which is Thursday. And it's probably the big mover from the FTSE 100. Someone was showing me actually, when you look down the bottom end of the 20 worst performing stocks of this year so far in the FTSE 100, there's a lot of names that we might associate as being reasonably high quality names. Bunzl is down there, Experian is down there, Relics is down there, London Stock Exchange Group is down there, 3i is probably down there now. In general, it's not been a good year for kind of high quality. What it has been a good year for so far is, and they're allowed to have a good year, what you would call a certain kind of cyclical. So banks and airlines in general have been running away with things, I think, in 2025. And the point of cyclicals is that they do have their time. They are meant to go up pretty well when things are going their way, and things have been going their way pretty impressively recently. But 3i was doing well up until, well, today, effectively, and they launched a trading update. I will say this is their half one results, and it covers a little bit of the period, the 10 months from the start of the year to the end of October, which is a large half, and this kind of maths might be something that kind of confuses people, but it confuses me, certainly, the idea they have unequal sized halves. I'll come back to this thought in a moment, but it's been a tough time in general for private equity companies over the last sort of 12 months. What you've seen is Apollo is down, KKR is down, Blackstone is down. They're all down in the region of 20% or so each. In that time, 3i is up. Not a huge amount up, but it is up when all the others are down. And we'll come back to why in a moment. But even after this latest big hammer, it is off where it's still better than those guys on the last 12 months. Anyway, I was thinking about selling 3i, incidentally, the other day. I looked at it and thought it's trading at a price to book ratio of 1.8. And I think that book is actually based on some quite punchy valuations. But if I sell this thing, I don't know when I'm going to get back in. That turned out well. Anyway, they have, in the first 6 months of the year, the actual first 6 months of the year, they've managed a 13% return on equity. And that doesn't mean 13% over the course of the year prorated. That means they've returned 13%, so a 26% run rate for the year. That's a pretty good return on equity. It's actually only about in line with what the FTSE 100 managed in the first half of the year. That was also up around 13-14%. But the point about 3i is it does it much more consistently than FTSE does, which is why it's run away from the index over the last 5 or so years. Been one of the best performing stocks in the FTSE 100, and certainly one of the best to have been in the FTSE 100 for all that time. So something like a Diploma or even a Games Workshop. Quite a few of their gains came while they were in the 250. Anyway, the net asset value now goes to £28.57 after the latest falling off, which gets the share price was around $33.95 from what I was seeing earlier. That gets you to a price to book ratio of about 1.2. And for something with the kind of assets that 3i has and the kind of past performance that it has, I think 1.2 is a very nice number to be buying this at. And I do think it's a buy, but there is more to this report than just that. I think 1.8 is kind of pushing it and 1.2 is kind of low. But the stock fell quite sharply, and I have a general rule that I was going to propose for you, Steve, or at least a rule that I'm going to try and live by here, which is you're not allowed to buy a dip unless you know why that dip is happening. And you can't just look at it and say, we said this off air a little bit beforehand, but just looking at it and saying, well, it's because it's a stock market and it's irrational, isn't it? Is not a good enough reason. You need a clear sense of what it is that the market is reacting to, what it is that they're seeing. And in a lot of the coverage that I saw today on 3i, I got the impression that analysts do not know what the market is reacting to here. Because I think the market is reacting to something. There's a meaningful 18, well, maybe 17.5 is a bit much. I think it is. But there is a meaningful something in this report to not like. And one of the things that some of the reports have been flagging is the CEO's comments going forward. So Simon Borrows, who's in charge at 3i, warned about a kind of uncertain outlook and said they're looking to be cautious with deploying their capital in the next few months and they're wary of the macroeconomic situation and so on. That isn't a positive thing. It's also not the reason this stock is down, as far as I can tell. I can't believe that this stock is down 17 and a bit percent, partly because he said this last time, and everyone knows this already. there is nothing newsy in that. I mean, you can be down a bit because you think guidance is a bit weak or something like that, but he didn't say anything to justify anything like a 17.5% down in this. So that's not the issue, even though I was seeing it reported as 3i falls on weak guidance or pessimistic outlook or something. There is a pessimistic outlook and it is down, but that's not the reason why. The issue is Action. And Action is their largest investment by a long way. It's about 80% of their portfolio. It's a European discount retailer, for those that don't know, and it's been a really, really, really successful investment for them since they started buying it a while ago. If something's 80% of your portfolio, you should probably pay a lot of attention to that thing. And 3i do pay a lot of attention, and their investors do pay a lot of attention. It is, if you want to compare it lazily, and I'll come back to why I think this is a lazy comparison, it is a bit like Primark is to Associated British Foods. There are other things going on, but no one really cares about them, and realistically, you're watching Primark like an absolute hawk. 3i is a bit different, and I'll say why in a second. But sales growth at Action then for the first 10 months of the year was 16.3%, which is pretty good, to be honest, for a retailer. That's a nice big number. But we've been seeing this, and this has been the theme of the year. Like-for-like sales growth was a lot lower, Steve. It came in at 5.7%. And 5.7% in the context of what we've seen elsewhere is not bad at all. We've seen Greggs posting 2%, and even Costco only posts about 6%, and B&M has posted nothing in terms of like-for-like growth. And all of these have managed to push numbers higher a bit by opening more stores, but you can't do that forever. And in the case of Action, the reason the market didn't like this is 5.7 is down a lot from where it has been before. About a year ago, it was clocking double digit, I think, and it's been fairly consistently at about that level before now. So they've been posting strong growth, and they've now moved on to, I'm not even sure it's great or good. I call it okay growth, 5.7. It's clearly ahead of inflation, and it's clearly ahead of a lot of other retailers. But here is the thing. Your growth is slowing here. That would imply a lower multiple. And 3i's book value, as they say at that price to book of 1.2, is based on an 18.5 times EBITDA multiple for Action. And when growth starts like getting down to the 5 areas and the like-for-like numbers, people start to wonder whether this thing is really worth 18.5 times EBITDA. You saw it happen with Greggs. Like-for-like growth went off a cliff and the stock got smashed. B&M's like-for-like growth has been terrible. Stock got hammered. Costco's is still all right, and the stock is doing very well, but you feel like they look vulnerable on that big PE ratio if something slows up there. Primark's like-for-like growth sales have been appalling, and ABF shares have faltered as a result. This is what's going on, I think, with 3i. That like-for-like number is too high. It's trading on a big 18.5, or it's listed on 3i's balance sheet. Sorry, it's not trading anywhere because it's private. At 18.5 times EBITDA. And so you have, that gives you 3i, which is a stock that is trading at a high book multiple based on some high valuations of the underlying things. And the underlying thing just got a bit worse looking than it was before. In terms of price to EBITDA, Greggs is at about 5, B&M's at about 2, Costco's at about 32. Action is in the middle of those at 18.5, and I think that's probably about the right place for it to be, but I can see that if it starts slowing down and looks more like a Greggs, it ain't worth being at 18.5. So that's your issue. Add in one more issue, which is what they said about what they've been doing in the last couple of months, which was buying a bigger stake in Action. And the problem with that is that means they've been buying the things at the value they carry it at, because that is typically the price they're willing to pay out. So they've been buying this thing at 18.5 times EBITDA, and it's growing like-for-like sales at about 5 and a bit percent. That's not amazing, is what I would say here. I do have a lot more positive stuff on this, but let's pause there for a moment, and I'll flip things over to you, Steve. I'll tell you why I'm not completely out on this thing in a moment.
So I think just reading through the report now and some of the comments that I've been able to access, it's, I mean, I don't like the use of the word resiliently. I don't like that word at all. I'm not even sure if it is a word. Is it not resilient just the word? Do you need to add the "ly" on the end of it? So that's already enough to have it down 20% in my eyes. But I think this general report just feels very cautious. The Action outlook is cautious regarding investment opportunities. They're kind of cautious about the macroeconomic backdrop. They're kind of cautious about making further funding decisions. There's a definite like risk off air to the reading of this the report. They're emphasizing being selective and cautious in terms of their capital deployment. And look, that's what you want from an investment arm. Remember, you are buying an investment arm. You don't want them just chucking good money after bad. You do want them saying, look, I think actually there might be serious issues here in the market that we can exploit at a later date. As Terry Smith says, whenever you need money, you don't get it. So if you've got some money at the moment, it might be wise to sit on it if you feel the market is degrading. But generally, Steve, like-for-like sales growth is still good and revenue is still good. You're getting volume growth, you're getting like-for-like sales growth. That's great for a retailer. And you've got to seriously think about where Action operates. It operates in... it's got a big amount of stores in France, which has obviously got this huge sort of political sort of backdrop issue going on at the moment, sort of political turmoil, could you say, Steve? It's a bit sort of to and fro. People are a little bit worried about how that's going to go moving forward. I think they've got 870 stores in France and 20,000 odd employees, I think. So French Retailer of the Year for the last 3 years, if I remember correctly as well. So they're right to be cautious about how it's going in the areas they operate. And I don't think really we've got the same sorts of problems in the UK, although I think people tend to like to overemphasize our issues in terms of when you compare them to, say, like France and things like that. I think they're in a lot more kind of turmoil than us. But yeah, I didn't really get. I mean, I know I said we wouldn't do it, Steve, and we can't buy the dip if we don't really understand where it's going now. But I'm going to be a little bit different to you in that I think the tone is kind of weak, but I think the sell-off might be, well, it might be reflective of a high evaluation. I guess that's all I can say is that it's obviously got this large premium to NAV, which has always been kind of justified by saying, look, we might be just a year and a half in front if you look at Action's growth. But the kind of, if they're hinting at softer trading in Action, then that premium needs to be eroded, doesn't it, moving forward? And that's essentially what's happened is investors have aggressively derated the stock today, and the market feels like the tone of this note is too cautious. Now, that might make 3i change what they're planning to do. But essentially, at the beginning of the year, they told us they wanted to open 370 net new stores, and they said that they're on track to do that. So they're not slowing down the rate of stores opening this year. It'll just be whether that happens moving forward. So yeah, I'm quite interested in this here, Steve. I think this is it's not a million miles off where I wanted it to be when we originally talked about it. Down about 8% on the year by the looks of it now. 7.5% on the year after a pretty good run up. Is it on the list of things that you're going to buy then, Steve, or is it still on the chopping block? How is it with you?
Buy in my case, and here's kind of the reason why. I mean, Action has a big growth runway in terms of opening new stores. I realise that those are one-off things, and sooner or later, like-for-like growth has to come and take over. And we've been saying that pretty much every show. Or I've been saying that pretty much every week, every retail company that reports for 2025. It's been one of my kind of running themes, but. Action does have more of an obvious runway for opening stores than other places. It's in several different countries in Europe and appears to be aiming itself into more. And I think it has fairly credible opportunities to compete there as well. But the real reason I kind of like this is because it's been a rubbish year for private equity, especially if you look over 12 months. And the reason it's been that is exactly the reason that 3i is a better version of most of these things. So the way private equity typically works is that you go and raise capital from somebody, whether that's a pension fund or an insurer or whatever that might be, sovereign wealth fund, maybe even in some cases, and you go away and then 10 years later you're supposed to give them about 2.5 times that back because you've gone off and bought stuff, and then you exit that stuff a bit later on and you sell it for more money than you bought it for, and you hand them their return and take out your fees. And generally speaking, over that 10-year period, what happens is you spend the first 5 years roughly buying stuff, and the second 5 years selling it all again. And the trouble with that is at the moment, we're getting into a period where 5 years ago was not a good time to be buying stuff because rates were basically at zero and they're not at zero anymore. And that's creating a challenge for your Apollos and Blackstones and KKRs. They are basically saying you're going to have to wait longer for your 2.5 times here. It's going to be more like 12, 13 years rather than the 10 years we were initially looking at, and that's making their customers cross. And the alternative to that is that they can inject equity of their own, i.e. pay to bump up the price from their own balance sheet, which isn't what they want to do. But that's the real challenge. There are also issues in private credit at the moment, which 3i is not involved in. 3i doesn't raise external capital, though, and it's actually managing its exits pretty well here. They mentioned two in the report that are kind of impressive. There's something called MPM, which is a pet food outfit that they bought in December 2020. They're realizing that at 3.2 times what they paid for it. Another thing called MAIT, which is a German software company, I think, realizing that, bought in 2021, now selling it at 2.8 times what they bought it for. I mean, they're actually doing a pretty good job of investing stuff here. It might be that they're dealing with smaller amounts of money, and the likes of Blackstone at the moment, you've seen fairly aggressively targeting the UK REIT market. I'm not sure you're going to triple your money in a UK REIT over 3 years, but maybe I'm wrong. Over 10 years, but maybe I'm wrong. We will see, though. I mean, what I'm impressed with 3i is their structure that lets them basically invest when they want and when they see opportunities, rather than when the cash shows up. As you pointed out with Terry Smith, it always shows up at the wrong times. Everyone wants to invest when prices are high for some reason. And that's the wrong time to be going about these things. 3i has the scope to try and wait for opportunities that it sees. You hope that they find a way to diversify that portfolio rather than just keep buying action, which is what they currently do. It's one thing to think, look, anyone can have a lopsided portfolio because you started it off pretty even and something just ran away from you. And that's a high-class problem to have. And you would say, or I think it's reasonable to say, actually, you shouldn't just sell down the position to get you to a more balanced, diversified portfolio or something. You don't chuck out a winner just to make it look like a loser. But it is also a good thing if they can find a use for some of the capital on their balance sheet that's coming back. They whacked the dividend up by 20%, though, which is that's pretty encouraging, I guess. So that now takes us to sort of 2 and a bit percent, which, well, a few more years of 20% ups in dividends, and it's being matched by growth in the underlying business. And I guess this could become a nice earner. But yes, I'm a buyer at these levels, Steve. We will see whether that's a mistake. If action really starts to deteriorate, then I will not feel good about this at all. But if it's a blip, then this could work quite nicely down 17.5%, I think. You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.